Okay, good evening. I think I'm audible. Shall we start? So, welcome to Agriadic platform. So, today we will be having a marathon session for the agricultural economics for your CUET PG 2026 examination. So, today this is how actually our lesson plan goes. We will be covering the major topics under agricultural economics such as microeconomics, macroeconomics, production economics, agricultural finance and agricultural marketing. So rather than going into the each and every specific definitions, we try to make you understand what is the concept behind each and every topic so that it will be much easy when you are appearing for the competitive examination, so that when some practical oriented questions are asked, you should be in a way to understand what actually the concept behind it, and you can solve the question. So this is how it goes. So welcome everyone, and first we will be dealing the microeconomics portion. So as you all know, economics is nothing but a subject which is actually dealing with the optimal resource allocation between the individuals of the economy. It can be environment, it can be a society, it can be a country, or it can be even the whole world when we are considering the natural resources. So economics has derived from two Greek words, that is oikos and nomos, which means household management, and any activity which is actually performed to fulfill the requirements of a human individual or an individual can be considered as an economic activity. And the basic idea behind economics is nothing but wants are unlimited and the resources to satisfy those wants are really scarce, and we can say that the scarcity is the pivot of the economic activity. So there are different types of economic systems such as capitalist economic system, where you can see only private system in this economy. When it comes to the socialist economic system, you can see only government oriented system. So in capitalist economic system, you can watch this kind of system in USA or UK. When it comes to socialist economic system, the former USSR was actually the socialist economic system where the decisions are taken by only the government. Then the communist economic system, this is actually an extreme form of socialist economic system, as you can see in China. Mixed economic system, it is nothing but the combination of capitalist and socialist economic system, where you can see the combination of private sector as well as the public sector. And the final barter economic system is nothing but commodity to commodity exchange system, which was actually prevalent very anciently. And this is the subject matter of economics: wants, effort and satisfaction. So whenever some want is arised from a human being, he will be doing some work for that. That is nothing but the effort. After his efforts, he will be becoming satisfied with his want. So that's satisfaction. Again another want is reoccurring. So this goes on a cycle, and this constitutes the subject matter of economics. So there are generally four definitions of agricultural economics, such as wealth definition, welfare definition, scarcity definition and growth definition. So wealth definition was given by the father of economics, none other than Adam Smith. Welfare definition, an improvement of wealth definition, which was given by Alfred Marshall. Scarcity definition, which was the first scientific definition of economics, which was given by Lionel Robbins. And the final one, growth definition, which was actually given by Paul Samuelson. And when we are going in detail for the divisions of economics, there were traditional approach and modern approach. Traditional approach constitutes production, consumption, exchange and distribution. Production is nothing but when some inputs are transformed into the outputs, that entire process is called as production process, or we can say it is the creation of utility. And consumption, the produce which is actually an output of the production process is consumed by the individual. That is nothing but the consumption. What is exchange? It is nothing but the link between production and consumption. The farmer sells his product to the consumer through the exchange activity, which is actually done through the marketing. And finally the distribution, it is nothing but the total revenue which is actually generated upon selling the product will be redistributed to the factors of production such as land, labor, capital and organization in terms of rent, wage, interest and profit. That process is known as distribution. So this is the traditional approach. And coming to the modern approach, as you all know, upon the modern approach, divisions of divisions of economics constitutes micro and macroeconomics. Microeconomics, as the name suggests, it will be dealing with individuals, small individuals, small groups, right? Or you can say like individual consumers or individual firms or individual industries. But when it comes to macroeconomics, as the name suggests, it is actually constituting a large number of group. Like it's the study of aggregates. Like you can say that national income calculation of the entire India or an entire economy will be constituting the macroeconomics. Then economics can be considered as a positive science and normative science. A positive science means it explains what is, or we can say the cause-effect relationship. It is just the functional relationship between the cause as well as the effect. So it answers the question of what is. But at the same time, normative economics is the answer for the question what ought to be or what should be. So this actually just explains what are the facts, but normative economics is a little more policy oriented. Upon analyzing the facts, the normative science tells like what should be happening in the future. So that is the difference between positive science and normative science. Remember, economics is both a positive science as well as a normative science. Then while going for a economic investigation, we have two types of methods. First one is deductive method and second one is inductive method. Deductive method, what actually happens in deductive method? We are proceeding from the general facts to the particular conclusions. We will be studying the entire population, then we will be making logical conclusion regarding a particular individual in the economy. But at the same time, in inductive method, it's like the population census. We will be collecting the data from the particular and proceeding to the general. So we will be surveying the each and every individual population, getting the data and compiling the data. We will be making as logical conclusions on the entire economy. That is nothing but the inductive method. So these are two methods of economic investigation. So these are some of the basic assumptions used in agriculture, in economics. First one is ceteris paribus. Ceteris paribus is actually a Greek phrase which means every other things being constant. So in economics, when we are studying two variables, rest every variable which actually affect these variables will be assumed as constant. That is denoted by this phrase ceteris paribus. And the rationality of the human conduct is nothing but each and every individual in the economic system are supposed to maximize their profit or maximize their satisfaction. There is no underutilization of resources. If I have 1000 rupee in my pocket and if I am going for a resource allocation study, I will be spending this 1000 rupees in such a way that I will be getting maximum satisfaction out of spending this 1000 rupees. I am not going to spend 500 rupees and keeping 500 rupees in my pocket, or I will not be spending like I have 1500 rupees with me. So that is nothing but the rationality of the human conduct. Finally, in the laissez-faire approach, laissez-faire is actually a Latin phrase. So this is the difference between ceteris paribus and laissez-faire. Ceteris paribus is a Greek phrase. Laissez-faire is a Latin phrase. So laissez-faire approach is nothing but we are assuming that there are no government intervention. See, in India, there are many government intervention schemes are there. So right now, when we are studying the economic system, if we are assuming that the government intervention is negligible, or we are assuming that there is no government intervention, we can say that there is a laissez-faire policy or laissez-faire approach. So these are some of the basic assumptions that generally we are using. So the difference between good and service, as you know, good is nothing but anything which actually we satisfies the human wants. Like the same way that how you are using your mobile phone to watch this class, like the same way how you are going for your dinner to satisfy your hunger. All those things are goods, like food items or machineries or pen, paper, clothes, or whatever it is. If it satisfies your human wants, it is good. It is perishable, it is material in object, and it is tangible, which can be destructible and you can physically feel it. Like I am feeling the same pen, or I can even destroy it, right? So that is the peculiarity of good. But what about service? Service is nothing but any act or performance that one party can offer to another. Like the same way that I am teaching this to the agricultural economics to you, that is one service. So service, you cannot touch it, or you cannot you can just feel it. Okay, you cannot materially transfer it. So service is any act or performance that one party can offer to another, like teaching, or maybe a service of engineer, or an act of doctor, or a lawyer, or a farmer. Everything can be considered as service. So this is actually inseparable from the person. So this is the difference between good and service. So before proceeding, I mean, in between, I'm just reminding you one thing. Like we have a mock test bundle available in our platform. So since only for 5 to 6 days are pending for the examination, you can make use of this mock test bundle to analyze what actually you have learned, and it will be also refreshing all the concepts that you have already studied. Also, another advantage is like this mock test bundle will be accessible till your ICR PG examination. So make use of it, and it will be really helpful for you. So coming to the classification of the goods, goods can be classified based on the supply as economic goods and free goods. Economic goods is nothing but those goods which actually or we can say that the supply is very much lesser than that of the demand. So its availability will be much less. Such kind of goods are known as economic goods. These goods are actually almost man-made. But when it comes to the free goods, these are free gift of nature because its supply is abundant rather than demand. So when we are comparing the demand and supply, economic goods, the supply is always less than demand. But at the same time, free goods, the supply is always greater than demand, like the sunlight or water or air that we breathe. Everything is abundant in supply, right? So this is nothing but the classification of the goods as economic goods as well as free goods. Then by Marshall, the goods are classified in based on the transferability as external material transferable, external material non-transferable goods. So I will be giving you some examples so that it will be easy to understand. The external goods are nothing but the goods which is actually touchable or external to a person. So there are material goods like pen, paper, rubber, or the phone, or whatever things that we can transfer from one person to another person. Those are material transferable goods. But there are some material non-transferable goods like your degree certificate or maybe your Aadhaar card or maybe your passport, because you cannot transfer to some other people, because even if they are getting your SSLC like +2 certificate or 10th standard certificate, they cannot make use of it, right? So those are material but non-transferable goods. Then there are some personal transferable and non-transferable goods, or you can say that internal transferable or non-transferable goods. There are some internal non-transferable goods, like I cannot share my friendship to somebody else, right? I cannot transfer, like I have a good friend, but I cannot tell that this friend is a good friend of mine, so you should be also a good friend of him. No, we cannot tell that, right? So those are internal non-transferable goods. But there are some internal transferable goods like a goodwill of a business. Even if the owner changes the business firm, if they are having a good consumer opinion about the product, even if the ownership changes, they will be following the product because of the product quality. That is nothing but a goodwill of a business. That is an internal but transferable to somebody else. Then coming to the consumer goods and producer goods. Consumer goods are the goods from which we can directly derive the satisfaction, like the same way that you are deriving the satisfaction by using your phone. But there are producer goods. These are some of the raw materials which actually helps to produce the consumer goods, right? For example, if we are taking a paddy farmer, rice is actually a consumer good because directly we can cook it and eat it. But at the same time, the commodities which we are used to produce the rice, like seeds or maybe fertilizers or maybe pesticides or maybe machineries, those can be considered as producer goods. So producer goods are those goods which we used to uh, make the consumer goods. So these are the goods which is classified based on the consumption. And based on the durability, there are monoperiod goods and polyperiod goods. Once if you are using and exhausted, then that is a monoperiod good. For example, the food items. Once you are eating it, there is no food items left, right? So those are monoperiod goods. But at the same time, polyperiod goods are like the phone that you are using. Even after the life, you will be using it for Instagram, YouTube, Facebook, or whatever it is, right? So polyperiod goods, like multiple times we can use it over a time period. That is nothing but the monoperiod and polyperiod goods. Then coming to the utility. The concept of utility is nothing but it is actually the want satisfying power of a commodity. If I have a pen, the ability of this pen to satisfy my want of writing is nothing but the utility. So if this pen is actually having ink, I can say that this pen got utility. But if it is an inkless pen, I can say that this pen has got zero utility. Why? Because there is no point of utility here, or my want is not satisfied with the inkless pen. So that is the difference between that is the concept of utility. So it is nothing but the want satisfying power of a commodity. Then there are 4 types of utilities, such as form utility, place utility, time utility, and possession utility. Form utility is nothing but the utility achieved by transforming the form. Like the coffee bean has been transferred to the coffee powder, or maybe the milk has been transferred to the curd, or some other products, like, or maybe the coconut is transferred to the natadi cocoa. So the form is changed. So therefore the value also changed, or the utility also changed. Place utility, when the location of the product changes, like the apples are transported to the South Indian places where actually it is not at all available, it will be getting higher price, right? So that is nothing but the place utility. Time utility, if at some means there is a difference between the production as well as the consumption due to the time, that is nothing but the time utility. So this is actually achieved by storage, storing something which was actually available at on season will be stored to the off season. So in the off season, since it is not available, it will be having some fetching some value. That is nothing but the time utility. And finally, the possession utility. What is possession utility? When I am owning it or when I am transferring it, if I am getting some utility, that is nothing but possession utility. Like I am selling a product to somebody else. Like a paddy farmer is selling that product to a consumer who is actually not cultivating paddy. So the value recognized by those people who are working in a government sector and not cultivating paddy will be much higher when we are comparing to the farmer who is actually producing paddy, right? So that is nothing but the possession utility. So there are 4 types of utility, such as form utility, place utility, time utility, and possession utility. Then there is value and wealth. So value is nothing but the capacity of a good to command some other things in exchange. For example, if I'm having a pen which is actually having ink, I can say that I will exchange this pen if you are giving me another pen, right? At the same time, if I'm having an inkless pen and I am asking my friend that I will be giving you this inkless pen and you give me a pen which is having full ink, he will not be ready. Why? Because my commodity with no ink is having no value at all, because there is no commanding power to get that thing in exchange. Or we can say that it is the rate of exchangeability. Okay, value is nothing but the rate of exchangeability. So if a commodity should have value, it should have 3 properties. First one is it should be having utility, the want satisfying power, like the ink pen, which actually helps me to satisfy my want of writing. Then the goods must possess scarcity. It should not be much available. The supply should be always less than demand. And finally, the goods must be possessing transferability. I should be able to transfer this thing to somebody else. And when this value is expressed in monetary terms, such as rupees or dollars or pounds, then we can say that the value becomes price of a commodity. So exactly what is the price of this one, this pen? Maybe 10 rupees, right? But this 10 rupees is nothing but the value expressed in monetary terms. So that's why this becomes price. So it had a value which is expressed in monetary terms, it becomes price. So that is the difference between value and price. And what actually wealth is, anything which is having value can be considered as wealth. So this pen can be considered as my personal wealth. The phone that you are having will be considered as your personal wealth, right? So this is the difference between value, price, as well as wealth. Then there are human wants, as we have already told. Wants are the first point of the starting point of economic activity, we can say, right? So wants, effort, and satisfaction was the subject matter. So economic activity of humans is directed towards satisfying their human wants, and the fulfillment of the human wants is nothing but the ultimate goal of every economic activity. So wants can be classified into 3, such as necessaries, comforts, and luxuries. So what are necessaries? Those wants without which we cannot survive. Like you want to drink water, you cannot live without having food, right? Such kind of things are called as necessaries, absolutely needed for your existence or for your livelihood in this earth. Second one is comforts, we will come to that. Third one is luxuries, anything which is actually even without that also you can live, but at the same time you will be purchasing it. Why? Because you will be having a prestigious status in the society. So if you want to see the if you want to see the what we call for it, if you want to use the mobile phone, you can just go for a normal maybe 20,000 or 25,000 smartphone, which is actually having almost all the uh, characteristic features which actually you required. But why actually people are preferring iPhone? Maybe over 1 lakh rupees they will be spending for a single phone, right? Why? Because having that phone is actually giving you or making the people a little more prestigious status which will be given to the people. So that's why it is known as luxuries, without which also you can survive, but that will be giving you some prestigious status. Comforts are those human wants which actually comes between necessaries as well as luxuries. So imagine that I am a student. So if I can learn from anywhere, right? If I have a book, I can learn it from anywhere, even sitting in the ground, right? But if I am provided with a good table and chair, my efficiency will be much higher. Such kind of human wants are known as comforts, without which also you can survive, but with the comforts it will be much better, it will be increasing your efficiency. Such kind of things are coming under necessaries, comforts, and luxuries. And these necessaries are again classified into necessaries of existence, necessaries of efficiency, and conventional necessaries. Necessaries of existence is nothing but like without which you cannot survive, like food, cloth, and shelter. Necessaries of efficiency, those necessaries which helps you to increase your efficiency, such as like having a nutritious diet, and the conventional necessaries because of some rituals or because of some habits. If we want to do something, such kind of things like smoking, drinking, gambling, all those wants are coming under this conventional necessaries. Then coming to the consumer behavior analysis, how actually a consumer is going to behave in a particular economic system. So consumer behavior analysis is actually studied based on two approaches. First one is cardinal approach and second one is ordinal approach. Basic idea of cardinal approach and ordinal approach is nothing but cardinal approach, we are assuming that the utility is measurable. Utility is measurable. Here it is not like that. Here we are telling that utility is not measurable. And cardinal approach has coined by, or we can say proposed by, none other than Alfred Marshall. And under cardinal approach, we will be studying three laws, such as law of diminishing marginal utility, law of equimarginal utility, and consumer surplus. So all these three things was also proposed by Alfred Marshall, who is actually the proponent of cardinal approach. And all these three laws are telling that the utility or the satisfaction is measured by some kind of imaginary units, which is nothing but utils. In fact, in practical life, it is really impossible. But as this was an early proposition to analyze the consumer behavior, these things assumed that the satisfaction of the consumer can be measured in some scale. Okay. Second one is ordinal approach. Ordinal approach was actually proposed by Hicks and Allen, and the major idea of ordinal approach is consumed by using the indifference curve approach. So remember, what is the difference between cardinal approach and ordinal approach? Who have proposed these things? And what is the basic assumption underlying cardinal approach and ordinal approach? What are the major tools which are used in cardinal approach and ordinal approach? LDMU, LEMU, and consumer surplus in cardinal approach, indifference curve analysis, and also there is another theory which is also known as revealed preference hypothesis, RPH, which was proposed by Paul Samuelson. And these are the two tools which you can say that the ordinal approach is actually using. So what is law of diminishing marginal utility? According to this law, it's nothing but if I am continuously consuming something, like if I am continuously consuming mango juice, or if you are continuously listening to this live session, on the course of time, for each unit consumption, the satisfaction you derive will be much lower because your brain rot will be working, or you can say that your satisfaction is going on a low graph, right? Or initially you will be much enthusiastic, but as the time proceeds, we will be feeling so frustrated, right? Like as the content goes in. So therefore that is nothing but the law of diminishing marginal utility. If you are continuously consuming something, or if you are having additional satisfactions, the additional satisfaction that you are getting will be lesser and lesser if you are considering with the previous unit that you are consumed. So additional benefit which a person derives from a given increase of his stock of a commodity brings lesser and lesser utility. That is the basic idea of law of diminishing marginal utility. So if you are considering like I'll giving you an example. So if you are continuously consuming some mangoes, so 0 mango, 1 mango, then again second mango, then third mango, fourth mango. So if you are checking the total utility, it's nothing but the total satisfaction. It will be having an increasing slope, which will be having a higher point. At some point of time, it becomes maximum, and then after that, when your stomach is so full, even if I am if I am asking you to again eat it and eat, like you will be having some stomach pain or some vomiting tendency because your stomach is already full. So therefore you will be having dissatisfaction. So your total satisfaction will be first increasing, it reaches a maximum, then after that it will be decreasing. So if we are checking the additional satisfaction that you are getting from each unit of mango, from first unit of mango you got 10 units of utility. From second unit of mango, obviously not like first unit of mango, because in the second unit of mango you are almost full in your stomach, right? And you already know the taste, so you will not be feeling that much happiness in the second unit of mango. So second, it reduced to 8. In the third mango, it reduced to 6. So additional consumption of mango will be giving you lesser and lesser additional satisfaction, so which is actually depicted by a negatively sloping marginal utility curve. So even though the total utility is getting increased, marginal utility is decreased, and when the total utility is maximum, marginal utility is 0. there is no additional satisfaction. And finally, if I am insisting you to eat again and again, the vomiting tendency or maybe the stomach pain that you are feeling will be given by the negative utilities here. Okay, so marginal utility is positive, but sloping first, then it becomes 0, and after that it goes on decreasing and it becomes negative. This is the basic idea of law of law of diminishing marginal utility. Coming to law of equimarginal utility, in law of diminishing marginal utility, we were actually considering only one product or consuming just one product. Here we have many products and we have only limited resources. There we had infinite number of resources. We have limited resources here. That is the first point. Second point, we have more number of products. So if I am having 1000 rupees and if I have 3 products, how I will be allocating this 1000 rupees to among these 3 products? That is nothing but the idea which is consumed under this law of equimarginal utility. So upon equimarginal utility, the law suggests that whenever I am allocating this limited resource into each of these particular commodities, maybe 3 vegetables such as tomato, potato and ridge guard. So whenever I am spending each 100 rupees on each of these vegetables, the additional satisfaction or the unit satisfaction of this 100 rupees that I am spending on each of these will be equal in every cases. So if I am considering 1000 rupees, there will be 10 rupee notes, right? There will be 10 rupee notes. So when I am allocating each and every 10 rupee notes in each of these commodities, the satisfaction I should derive from each of these commodities should be same. That is the idea of law of equimarginal utility. And this is actually a multi-commodity case when we are comparing about, regarding the law of diminishing marginal utility. So but practically it is impossible to get the same satisfaction. At that point of time, we will be going it in a descending order. So since there are potato, tomato and ridge guard, and if I am having 25 rupees, and imagine that potato, tomato and ridge guard, for each units it is 5 rupees. So there will be 5 rupee notes, right? 1, 2, 3, 4 and 5. So where I will be spending this 5 rupee notes in potato, tomato and ridge guard? That is our question. So first 5 rupee note I will be spending on that commodity where I will be getting maximum satisfaction, right? So among these 3, potato, tomato and ridge guard, the first 5 rupee note will be going to tomato as it is having the highest utility among all these commodities, right? So tomato will be having the first 5 rupee note. Then after that again I will be giving to tomato because 21 utils, but the potato is having 19 only highest, ridge guard is having only 18. So second one also goes to tomato, third one also goes to tomato, fourth one, since if I am continuing on tomato, what actually happens, it will be giving me only 16 utils, but at the same time I have much better option here. So the fourth unit will be going here and the fifth unit will be going here. And finally, if I want to get maximum rational, if I am a rational consumer, if I am getting maximum satisfaction, this 25 rupees should be spent on 3 tomatoes, 1 potato and 1 ridge guard. That is the best ever combination that you are going to get. So this is the basic idea of law of equimarginal utility. Then coming to the consumer surplus, again the third law under the consumer behavior analysis, which was also given by Alfred Marshall. So what is the consumer surplus? Consumer surplus is nothing but it is the difference between what actually I am able to give and what actually I will be willing to pay. That is the difference between difference between what I am willing to pay and what actually pays. Imagine that I am going to the shop and if I am going to purchase some mango, if 1 kg of mango I was ready to pay 100 rupees, but the shop is actually only for 80 rupees for 1 kg of mango. So I was ready to give 100 rupees, but I am only paying 80 rupees. So the additional 20 rupees will be there in my pocket. That is nothing but the consumer surplus. I was the consumer, I was ready to give 100 rupees, but he was only charging 80 rupees for 1 kg of mango. So additional 20 rupees was there in my pocket. That is nothing but the consumer surplus. That is the difference between what is willing to pay and what actually pays. Then another idea of this consumer behavior analysis when we are coming to the ordinal approach is nothing but the indifference curve. So indifference curve, we are trying to get the combination of 2 goods which are substitutes. Okay, substitutes are nothing but I can use one for another. For example, the soft drinks of 7-Up and Sprite, more or less both of these are having same taste, right? So if I'm not getting Sprite, I can go for 7-Up, or if I'm not getting Coca-Cola, I can go for Pepsi, right? If I'm going for sweets, if I'm not getting Dairy Milk, I can go for Milky Bar. So these are substitutes, right? So indifference curve is actually a graphical representation which actually portrays combinations of these two goods, units of two goods, where I can substitute from one to another, and each and every combination gives me same satisfaction. That is the basic idea. So along the indifference curve, you can say that even any combination you can take, you will be getting the same satisfaction. And the indifference curve are convex to origin, as it is actually having a convex shape towards the origin. So convex to origin, it is actually negatively sloping because addition of one sprite will be subtracting your additional unit of 7-Up, right? Because if you want to substitute one, you have to reduce one and add one more. Then only your satisfaction will be matched with the previous combination. So it is negatively sloped. Every indifference curve will be non-intersecting. It will be like placed over another. This will be indifference curve 1, this will be indifference curve 2, this will be indifference curve 3. And if you are checking the satisfaction level, the higher indifference curve will be having higher satisfaction. Like IC3 will be having higher satisfaction than IC2, and will be having higher satisfaction than IC1. So these are some of the basic ideas of indifference curve. Then along with the indifference curve, we will be using the budget line also. Budget line is also actually a graphical representation of two commodities. Along the indifference curve, what was constant? It was the utility or the satisfaction that the consumer derives. In every combination, we had the same satisfaction. But here, this is also combination of two goods like Sprite or 7-Up or Coca-Cola or Pepsi, or you can say the Dairy Milk or Milky Bar. But along the curve, what is constant? It is the amount that you are spending. Maybe it will be 100 rupees. So all this combination you can purchase with 100 rupees. So budget line is actually the graphical representation of two commodities which you can purchase with the same amount of money or same amount of resource. And this shows all possible combinations of the goods that could be purchased with a given amount of income. So we have indifference curve as well as we have budget line. So right now we have to understand the consumer equilibrium. So consumer equilibrium will be, you can say that there are many indifference curves that you can draw, and we will be having only a budget line because it will be deciding how much rupee you have or how much money you have, right? So the indifference curve, which is actually tangent to the budget line, because see, I3 is actually having higher satisfaction, but it is actually much beyond the budget line. I1 is actually having very less satisfaction, but it is attainable with the same amount of resource. But there is a combination such as P. So here, this much amount of X and this much amount of Y will be giving you the better satisfaction, and which is under your monetary resources, right? So that's why the consumer equilibrium is derived as the tangency point between the indifference curve as well as the budget line. So this is how actually the consumer equilibrium is arrived based on the ordinal approach. So we have seen the cardinal approach and we have seen the ordinal approach. Then there is the basic idea of demand. Demand is nothing but how much we require a product. So in economic terms, we can say that the willingness and ability to pay for a particular commodity. For an individual commodity, you can say it as individual demand. For a particular commodity, there will be many consumers. So if you are horizontally summating all these demands, individual demands, you will be getting the market demand. And there are three types of there is also autonomous demand and derived demand. Autonomous demand is nothing but the demand for a good is not linked with any other commodity. That you will understand when I am telling derived demand. Derived demand is nothing but demand for a commodity will be depending upon demand for some other products. For example, if you are demanding some rice, the demand will be connected with the paddy cultivation, right? So the demand of the paddy cultivation will be in turn what we can say linked with demand for many other commodities such as seeds or maybe fertilizers or maybe pesticides, machinery, labor. So demand of a particular commodity is connected with many other products. That is nothing but the derived demand. So but at the same time, autonomous demand is nothing but the demand which is actually not at all linked with any other commodities. Then there are three types of demand: price demand, income demand, and cross demand. Price demand is nothing but the quantity demanded for a particular commodity at different prices of the commodity. Income demand is nothing but the quantity demanded for a particular commodity at different income levels of the consumer. What is the shape of the demand curve? What is indifference curve? I think we have already discussed the indifference curve. Okay, shape of the demand curve, we will be coming to that. Income demand. Income demand is actually the demand quantity demanded, which is actually yes, the amount the quantity demanded by a consumer at the different income levels. At the same time, cross demand is nothing but there will be two commodities, maybe substitutes or complements. It can be related commodities. When price of one commodity affects the quantity demanded of other commodities, such as bread and jam or bread and butter, we can say that the cross demand is there. So how actually the quantity demanded of a particular commodity varies upon the changes in the price of the other commodity will be giving you the cross demand. So price demand is there, income demand is there, and cross demand is there. These are the types of demand. Then coming to the law of demand, as you all know, law of demand is nothing but it shows the inverse relationship between the price and quantity demanded. Imagine that the price of the commodity was 20 rupees. You will be purchasing 5 units of pen, right? 5 pen you will be purchasing. If the price has increased to maybe 30 rupees, you will be purchasing only less, maybe 3 pens. If the price has reduced to 10 rupees, you will be purchasing more. That is maybe 10 pens you will be purchasing, right? So when the price increases, quantity demanded reduces. When the price reduces, quantity demanded increases. So there is an inverse relationship between the price and quantity demanded. And as you asked, the demand curve shape will be a negatively sloping curve. It will be a negatively sloping curve, oftenly convex to origin, like the same way that you have drawn the indifference curve. Okay. So indifference curve, like the same way indifference curve, demand curve is also a negatively sloping curve, which is actually convex to the origin. So law of demand explains the inverse relationship between the price of a commodity and quantity demanded of the particular commodity. Then there are some exceptions where we cannot say the inverse relationship. Maybe the price increases, quantity demanded also maybe increase. Such examples includes Giffen's paradox. All the goods which is following the Giffen's paradox is also known as Giffen goods. Then there are some prestigious goods like gold, silver, diamond, or maybe the some luxurious cars like BMW, Audi, or whatever it is. Then the conspicuous consumption such as luxuries, ignorance effect. If the people are not knowing about the price and quantity details, fear of shortages because of the COVID pandemic or something, people are expecting the price to rise, so that therefore even the price is higher, people will be uh, consuming more. And finally, the network negative externalities, like how actually other people around me are purchasing something, that will be affecting my consumer behavior. Such kind of things will be some exceptions of law of demand. So remember this for the examination. So as we say, uh, law of demand curve was actually a negatively sloping curve. So in the x-axis, we will be having quantity, and in the y-axis, we will be having the price. Okay, so what is extension of demand? When the price increases, the quantity demanded will be more, right? So initially it was OX1, right now it has increased to OX2, right? There is an increase because of the reduction in the price. So increase in the quantity demanded along the demand curve due to the price change can be considered as extension of demand. At the same time, what is contraction of demand? If the price is increased, when the price is increased, initially my quantity was OX1, but right now it has reduced to OX2, right? Right now it was OX2. So my quantity demand has reduced just because the price has increased. That is nothing but the contraction of demand. So when the quantity demanded is more because of the price change, that is extension of demand. When the quantity demanded is less because of the price change, it is contraction of demand. Then comes the increase and decrease in demand. Whenever you are seeing increase and decrease in demand, you can say that there is a shift in the demand curve. So in the extension and contraction, it was just because of the effect of price of the commodity. But there are many other factors which can alter the quantity demanded, such as income level of the consumer, or maybe the population size, or maybe the price of the related commodities, or maybe the seasonal changes, or maybe the policy of the government, right? Many other factors can change the demand for a particular commodity, which will be shifting your demand curve. Extension and contraction, there were no shift, it was along the demand curve. Right now the quantity demanded is going to change through a shift of the demand curve. So whenever you are seeing there is an increase in the demand, there will be a rightward shift. Okay, there will be a rightward shift or there will be an upward shift. So this was demand 1 and right now this is demand 2. So this is the increase in the demand. Similarly, how actually a decrease will be happening? This was the initial demand, this was the final demand D1 to D2. So a leftward or a downward movement of the demand curve will be signifying the decrease in the demand. So always remember that increase and decrease in demand will be connected with the shift of the demand curve. Extension and contraction is happening along the demand curve. Extension and contraction is purely a price phenomenon. Increase and decrease is not due to price but some other factors, as I have already discussed. Coming to elasticity of demand, so even though there was a functional relationship between the price as well as the quantity of the demand, there were no mathematical relationship between the price and quantity. So elasticity of demand helps us to quantify how much actually the quantity demanded is changed based on the price. So this will be helping you to understand whether the commodity is less elastic or more elastic. So the price elasticity can be derived by this equation: percentage change in the quantity demanded upon percentage change in the price. So upon this equation, you will be getting a range of 0 to infinity. 0 to infinity is the range of elasticity. So upon this range, you can classify the elasticity into perfectly elastic, relatively elastic, unitary elastic, relatively inelastic, and perfectly inelastic. So in perfectly elastic, for a small change, infinitely minute price change will be giving you a large expansion of the quantity demanded. So therefore the elasticity of demand will be infinity here. This is actually the ideal condition. When we are coming to the perfectly inelastic demand curve, no matter what the price change is, the quantity demanded will be same. Imagine that you are consuming salt. Even the price has reduced or even the price has increased, the quantity of salt that you are putting in your meal will be the same, because below the quantity or above the quantity, that will be very much difficult for you, right? So no matter what the price is, the quantity demanded for salt will be the same. So therefore the elasticity of demand will be 0 and this is perfectly inelastic. So perfectly elastic and perfectly inelastic. There is unitary elastic. There we can say that the elasticity of demand is equal to 1, where the price change as well as the quantity change will be the same. Percentage changes of price change and quantity change will be the same. Then there comes the relatively elastic and relatively inelastic. So here the elasticity of demand was 1, as the name suggests, unitary elastic. Okay, when relatively inelastic, this comes between perfectly elastic and unitary elastic. So therefore it will be having a range of infinity, between infinity and 1. It will be greater than 1 but it will be less than infinity, and the demand curve will be much flatter here. At the same time, relatively inelastic curve, it is actually having a steeper curve, right? If you are checking it, it was having a flatter curve. It was having a flatter curve, but right now we have a steeper curve. So the range will be less than unity but greater than perfectly inelastic condition. So therefore it will be greater than 0 but less than 1. So these are the degrees of elasticity of demand: perfectly elastic, perfectly inelastic, relatively elastic, relatively inelastic, and unitary elastic. Then comes the supply. So demand we have already seen. What is actually supply? Supply is nothing but the amount that a person is willing to sell in a market at a particular price. That is nothing but the supply. So demand is actually from the consumer's perspective, what I am going to buy. Supply is nothing but from the seller's perspective, what I am going to sell, right? Then there is a difference between stock and supply. Stock is nothing but what are the things that he have produced, what he is able to give it to the market. That is nothing but the stock. But what the supply is, what actually he in fact sells in the market. Maybe he can store something in his in his particular area, right? So that is the difference between stock and supply. Stock is the amount which he can, but supply is what he actually sells in the market. That is the difference between supply. Law of supply, it's just exactly opposite to the demand. Price and quantity supplied. So in x-axis it will be quantity supplied. Now there it was quantity demanded, and price will be in the x-axis, sorry, y-axis, and the law of supply will be going like this. This is actually the supply curve. So what does it signify? Price and quantity supplied will be having a direct relation. In quantity demand or law of demand, it was inverse relationship. In law of supply, it is direct relationship. Why? When the price increases, farmer will be selling more. When the price decreases, farmer will be selling less. So there is a direct relationship between the price and quantity supplied. That was quantity demanded, this is quantity supplied. So similarly, okay, the demand and supply concepts are finished. Okay, coming to the concept of cost. Cost is nothing but what actually we want to pay for having some particular inputs. So such kind of things are called as cost. So broadly, cost can be considered or classified into short run cost as well as long run cost. So short run costs are nothing but those costs you can there will be at least some cost which is actually fixed, and there will be some variable cost. But long run cost, every cost will be becoming variable. So in short run, there will be some fixed factors and there will be some variable factors, but in long run everything will be variable. So fixed costs are nothing but no matter whether you produce or not, these costs will be there, like the rent for the land. If you are having 1 acre of land, even if you cultivate it or not, you may have to pay the rent for the particular commodity. Such kind of costs are called as fixed cost. Then what is variable cost? When you are using the input, obviously some cost will be there. Like if there is zero production, there is zero cost. If you are producing maybe half acre of land, there will be maybe 1,000 rupees for the fertilizers charge. If you are increasing the production, 1,000 will be increased to 2,000. So as per the input increases, the price cost also increases, right? Such kind of things are called as variable cost. So summation of the fixed cost and variable cost will be giving you the total cost, and this is the cost curve. So taking average of the fixed cost and variable cost will be giving you the average variable cost, average total cost, average fixed cost, and marginal cost is nothing but the cost which is incurred for producing an additional unit of output. And if you are considering this graph, always remember that the average total cost and average variable cost will be having a U-shaped curve. Also, the marginal cost is also having a U-shaped curve, and always remember that the marginal cost curve is actually passing through the lower points, the base lower points of the average total cost and average variable cost. So always remember that marginal cost, average total cost, and average variable cost are U-shaped curve, and marginal cost is passing through the midpoints of the average total cost and average variable cost. And there is average fixed cost. Average fixed cost is actually a continuously negatively sloping curve, and you can say the shape of average fixed cost is nothing but a rectangular hyperbola. Rectangular hyperbola. Always remember that this is actually a continuously negatively sloping curve. So average fixed cost is actually having a shape of rectangular hyperbola. So yeah, that's all about microeconomics. I think we have almost covered all the basic ideas and concepts of microeconomics. So shall we proceed to the macro? Then please give some responses in the chat box regarding the class till now. So coming to the macroeconomics, as we have already told, macroeconomics is actually the study of aggregates, right? Or we will be studying about the entire economy. So first we shall see how actually the national income is calculated. So national income accounting is nothing but calculating the entire value of goods and services produced in the entire economy during a particular period of time. Imagine that if we are considering 2025. Okay, thank you for the responses. Thank you. I think you can follow. Okay. Okay. So national income is nothing but the value of goods and services. No, AFC will not be becoming negative. AFC will not be becoming negative. It will be going on reducing. That's it. It will not never touch the x-axis. So that's why it is becoming a rectangular hyperbola. So national income is nothing but the value of goods and services which is produced in the a particular period of year, which is produced in the entire economy. That can be considered as national income. So here we should be understanding some important terminologies such as final goods and intermediate goods. So what is final goods? For example, in an industry, there will be a final output that can be considered as final goods. But imagine that in a paddy production, we will be using seeds, fertilizers, pesticides, etc. Right? and we will be producing paddy. So in this industry, paddy will be the final output. So this is the final good. But at the same time, the fertilizer that we have used here, maybe urea, this is actually another final product, right? Fertilizer is actually another final product of another industry, maybe urea producing industry. So if we are considering the intermediary good also, there will be a problem of double accounting. So you should only consider the final goods and service which is produced in the economy. If so, you will be adding paddy as a final output of the paddy production, fertilizers as a uh, final good of the fertilizer producing industry. If you are considering fertilizer as the intermediate good in the paddy production, again here also it will be counted, here also it will be counted. Your calculation will be wrong. So we will be only considering the final goods and services produced in the economy in a particular year. Then it will be expressed in monetary terms. So national income is a flow concept. So the difference between stock concept and flow concept is nothing but stock concept, we will be taking the value at a specific point of time. But flow concept, we will be considering an entire time period, like maybe from 2025 to 2026, we will be considering it, right? So such kind of concept is known as flow concept. Since we are considering an entire year, we will be the national income can be considered as a flow concept. And there are different sectors we have to identify before national income accounting. Primary sector, which constitutes agriculture and allied activities, forestry, fishing, mining, etc. In secondary, you will be having this manufacturing industries, electricity, gas, water supply, construction industries, etc. And tertiary sector is nothing but the service sector, like banking, insurance, communication, public administration, health, education, other services. So all these sectors should be included in this national income accounting. So how actually our economy is actually working here. So we have households, we have business firms. So from households, we will be selling the labor input, right? And from business firms, we will be getting the goods and services that we are producing. And there will be in between, there will be a financial market like bank. So household will be saving some money, will be giving to the bank. The business firm also, and this banks will be investing for the financial firms for the entire working of the economy. There will be also a government. So from household and business firm, there will be tax payment going to the government. Government will be giving some wages and salaries who are working in the government employees. Also, when government purchases produces from the business firms, they will be getting the revenue by from government to the business firms. And also there is a open economy like foreign countries. When since India is not a closed economy, India will be open economy. So we will be trading goods and services to the other commodities, to the other countries also. So from foreign countries to the households, as our family members are going abroad, they will be giving their labor there and they will be getting the revenues for that. From business firm will be exporting their products to the foreign countries and getting their uh, revenue for the imports. Or we can say that foreign countries, the goods and services will be imported from the foreign countries to the business firms. So this is how actually the entire economy is working. Yes, we can say final goods as consumer goods because it's ready to consume, right? It's since it is ready to consume, we can say that consumer. But there is an issue, like every final good cannot be considered as consumer goods. Why? Because if fertilizer is actually a final good from the fertilizer industry, but it is not a consumer good, it is used as a producer good. Idea of final good is nothing but we have to take the end product of each and every activity, not to consider the intermediary activity, not to confuse with the consumer good with the final goods. Okay, because consumer goods are directly satisfying, which actually gives us directly satisfaction, but fertilizer cannot be considered as a good which actually directly gives us the satisfaction. Okay, so when comes the national income accounting, there are different approaches like gross national product at market prices, gross domestic product at market prices, net domestic product at market prices, and net domestic product at factor cost. So always remember four important things which this will be helping you in your examination. Okay, first one is consumption expenditure, C. Second one is investment expenditure, I. Third one is government expenses, G. And fourth one is net export earnings. That is nothing but export minus import. Okay. So these are the major things that you have to understand before going to the national income calculation. So consumption expenditure, investment, government expenditure, and net export and import. If you are adding all these things, you will be getting the gross domestic product at market prices. Okay, what is this gross product at market prices? See, this is the this is I. Okay, net export, this is nothing but X minus M. Government purchases, this is nothing but G. And this is the consumer expenditure, this is C. Okay, so C plus I plus G plus X minus M will be giving you the gross domestic product at market prices. This is nothing but the value of goods and services which is produced under the territory of India. When we are drawing the map of India, what is actually produced in the territory of India and what is actually the thing. Okay, if we are considering the entire economy from the other perspectives, like maybe since when we are considering the people who have working in abroad also, they are sending some money, right? So when the trade is also considered, there will be a net factor income from abroad that will be also coming. So that when that is also considered, it can be considered as gross national product at market prices. When from gross domestic product at market prices, if we are deducting the depreciation, we will be getting the net domestic product. So always remember, to convert gross to the net, we will be deducting depreciation from the gross. So it will be becoming the net. Okay, so if you want to gross national product at market price to net national product at market price, sum all these things, less depreciation, you will be getting the net national product at market price. So right now we have reduced this depreciation from the gross domestic product at market price. So it becomes net domestic product at market price. Then what is the net domestic product at factor cost? Here it is nothing but wages plus profit plus interest plus rent. What actually we are getting as factor revenue. That is nothing but the net domestic product at factor price. Or if you want to convert this market price to the factor cost. See, here the NDP is same here, right? But we are converting the market price to factor cost. What do we have to deduct? We have to deduct the net indirect taxes. So gross to net, you have to deduce or subtract the depreciation. At the same time, if you want to convert the market price to the factor cost, you have to reduce the net indirect tax. So this is the basic idea of national income calculation. So upon the things that I have told you, you would be able to do any conversions between gross national product at market price to net domestic product at factor cost. So this net national product at factor cost is actually considered as national income. Okay. Then coming to national income or net national product at factor cost, it includes net factor income from abroad, profits, interest, rent, and wages and salaries. And from this, if we are reducing the undistributed corporate profits, corporate taxes, social security contribution, and when we are adding the transfer payments, we will be getting the personal income. So from personal income, if we are reducing the personal taxes, you will be getting the disposable income. So these are the major ideas that we are used in the national income accounting. I know it's actually a little troublesome idea to grasp in 2 or 3 minutes, but don't worry. As the provided Google form, if you need the content under this PPT, just fill the Google form. If you have already filled it, just ignore it. You will be getting the entire content right to your ownership. So don't worry about it. So if somebody actually really want this content, just fill the Google form which is actually given in the description section. So these are everything is actually different kinds of conversions from the gross national product at the factor cost to the net national product or net domestic product at the factor cost. So all these things are actually giving different approaches how to convert from one to another. And coming to another important idea of macroeconomics is nothing but inflation. Inflation is nothing but the persistent and continuous change in the price level over a long period of time. That is nothing but the inflation. So if price of a commodity increases, its real value, what actually happens to its real value? It reduces, right? Imagine that, like we used to get a poppins for maybe 2 rupees earlier, right? Right now for a poppins, it is maybe 10 rupees or 5 rupees, I don't remember. But the same 10 snacks or 10 sweets in the poppins is actually the same right now also. There is no change in the flavor, there is no change in the quantity, but the same quantity is actually sold at 2 rupees is becoming 10 rupees. This is actually showcasing the increase in the general price level, right? So the real value of the commodity will be diminishing when the price, the monetary price is actually increasing. So generally there are two types of inflation, that is demand pull inflation and cost push inflation. So if actually everybody require one thing, see what actually happens if you are going to Thursday market or maybe a Monday market. If demand is more for a particular commodity, obviously the price will be more, right? But at the same time, there is no demand at all. The sellers will be reducing the price so that the things should be solved, right? Such kind of things are known as demand pull inflation. Because of the demand in the economy, how actually the price level goes up. That is demand pull inflation. What is cost push inflation? Cost push inflation is actually also known as supply side inflation. For example, if I own a business firm and I'm getting almost 1 crore in every year, okay, and I just want to scale it up to maybe 2.5 crores. I want to make revenue of 2.5 crores extra. So because of that, in order to get that much without even changing my business scale, I am increasing the price of my product. Automatically, this will be encouraging my competitors to increase their product. Automatically, what will be happening? The price level is going up, right? So such kind of things can be considered as cost push inflation. It can be caused because of several reasons, such as oil price shock, or maybe because of farm price shock, or maybe import price shock, or can be wage push inflation, like increasing the wages because of some labor strikes or something also will be increasing the general price level. Because in order to pay my labors, I have to increase the price of the product. Increase of the price of the product will be increasing the price level of the economy. So that's how actually cost push inflation happens. So there are majorly two types of inflation. That one is demand pull inflation and cost push inflation. For NDP, we need to detect depreciation from GNP or GDP. See, net domestic product converted to net domestic product. When we, gross domestic product will be converted to net domestic product, right? So gross to net only we have to consider the depreciation. So if you want to get the net domestic product, you have to deduct the depreciation from the gross domestic product only. Because gross national product will be transformed to gross domestic product if you are minusing the net factor income from abroad, right? So if you are deducting uh, the depreciation from the gross national product, you will be getting net national product, not net domestic product. So correspondingly you have to reduct. Okay, Amul Naik, I think you got the point. Yes. Then there are another some kind of inflation upon the general change in the price level, such as creeping inflation, walking inflation, running inflation, galloping inflation. So what is creeping inflation? When the inflation rate, once the once the inflation rate is less than 3%, you can say that it is creeping inflation. When it comes the walking inflation, when it is ready increase from 3 to 6%. Running inflation, there is a sustained price change about almost 10%. And galloping or hyperinflation, you can say that it is the most dangerous type of inflation. It happens almost more than 60%, or maybe in the question paper you can say that it can be up to increased over maybe 20%. So the rate of inflation classifies the inflation into creeping, walking, running and galloping. Then there is open inflation. So when the market forces operate freely and there is no government intervention, there is no government checks to control the inflation, you can say that it is the open inflation. Suppressed inflation is actually an allowable rate of inflation in the economy. It is actually, government is actually allowing a little kind of inflation in the economy, because that inflation will be increasing the economic activity. In order to get good revenue, people will be producing more. So that will be helping in long term for the economic growth, but in a controlled way. That is suppressed inflation. Comprehensive inflation, when the price of all commodities in the in the economy is increasing, a comprehensive, every commodities prices are increasing. Such kind of inflation is comprehensive. Sporadic inflation among the primary sector, secondary sector and tertiary sector. Only inflation is happening in the secondary sector. That is actually just a little part, right? So such kind of thing is known as sporadic inflation. What is stagflation? Inflation along with severe unemployment in the economy will be giving you the stagflation. So these are some different kinds of inflation. And for controlling inflation, the things that we are using is fiscal policy, monetary policy and supply shock management. Fiscal policy is nothing but the government expenditure as well as the tax rate policies. Government expenditure and tax rate policies. Monetary policy is actually adopted by the central bank of the country, like RBI. Okay, in India, the central bank is nothing but the RBI. So RBI can control the inflation by producing less money. or you can say that like they will be uh, changing the bank rates, or they will be going for the open market operations. Then there are some supply shock managements to control supply side or cost push inflation. There should be control over wages, incomes, or increasing imports. So when actually the inflation is happening, when there are more money in the income but very less product. So supply shock management is nothing but to increase the supply to match with the demand, so that there will be no much increase in the inflation. That is nothing but the supply shock management. Then what are the effects of inflation for creditors or debitors? For creditors, it will be loss, and for debtors, it will be much higher, as inflation will be giving them more money. For fixed income groups, obviously, when the price increases, the real value will be reduced. So fixed income groups like salary earners or pensioners, the problem will be more. Then the businessmen and traders, they will be matching the the price movements, and they will be producing accordingly, so that they will be better off. Wealth holders or of cash, bonds, or debentures, they are also adversely affected. So whom all are adversely affected? Creditors, fixed income groups, creditors, fixed income groups, and wealth holders. Businessmen and the debtors will be having a little more good effect due to the inflation. Then unemployment is nothing but existence of involuntary what we call for it. Even if the people are ready to go for the job, they are uh, not finding any job in the economy. They are ready to go for the job, but they are not finding in the economy. That is the condition of unemployment. So there are three types of unemployment: frictional, structural, cyclical, and one more thing is there, Keynesian unemployment. Frictional unemployment, even in a good economy, even in an economically better economy, you can find a frictional unemployment. Imagine that. Uh, See, what actually happened when mobile phone was invented? Before that, for camera, we used to take the camera. We used to buy the cameras, right? Before that, for hearing songs, we used to use the tape recorders or radios, right? Before mobile phones, what actually happened? There were television industry, which was actually very prominent, right? But when the mobile phone came in the economy, what actually happened? When mobile phone came in the economy, they almost substituted all these things. So what actually happened at that point of time? Many people would have lost their job in those sectors, right? That is nothing but the frictional unemployment. When the technology advances, those people who are actually not that much outskilled in the uh, uh, area should be in a way to study some new skills to match with the economy space. Such kind of unemployment, a short term adjustment, is nothing but the frictional. Structural unemployment is nothing but when some technology is actually totally replacing something in the economy. Such kind of thing are structural unemployment. Cyclical unemployment is because of the different cyclical fluctuations in the economy, such as prosperity and recession in the economy, will be causing some unemployment due to the business cycles. So unemployment happens due to the business cycles, will be giving you the cyclical unemployment. And the Keynesian unemployment is also known as cyclical unemployment. Okay, we have seen all these things: frictional, cyclical. There is disguised unemployment. What is disguised unemployment? Very simply, if an activity can be done by 10 members, okay, if an activity can be optimally done by 10 members, and at that area we have 20 members, okay, so an activity can be efficiently done by 10 members, but right now we have availability of 20 members. So what will be happening? Even if we have ample number of people, many will be working first and then they will be taking rest, but it is not optimally done, right? Even if we are cutting down 10 from here also, you will be getting the final output without any loss. Such kind of unemployment is also known as disguised unemployment. Like the same way that we have many graduates right now, but the number of vacancies or posts which is actually we are having in the economy to smoothly run the economic system is much lesser. So that we can say that we have disguised unemployment in the system. So the marginal product of the particular worker or the labor will be zero or very less in the case of disguised unemployment. So is that clear? These are the major concepts which is coming under agricultural macroeconomics. Clear? Can we proceed to the agricultural finance right now? So agricultural finance is actually dealing with the um, amount of fund allocation or finance or credit to the farmers to run their agricultural operations smoothly. That is the basic idea of agricultural finance. So the credit has derived from a Latin word, that is credo, which actually known as I trust you. Imagine that I am lending you some money, like maybe 10,000 rupees. So I am giving this 10,000 rupee on a trust that you will be repaying me back at some point of time. That is the basic idea of credit. So credit is actually the loan or finance which is actually provided by an institution to the farmer to smoothen their agricultural operation. So credit is not considered as an income, but it actually leads to creation of income by indirectly affecting the production activities, right? So there are institutional sources and non-institutional sources. Institutional sources of credit includes all the commercial banks or land development banks or regional rural banks or cooperative banks. But there are also some other non-institutional uh, sources which may not be having any particular written agreement or something like that. Upon trust or upon some additional interest charged or so, they will be lending some credit, which includes landlords, relatives, uh, the money we are taking from friends, or maybe some professional money lenders, or maybe from traders also. So these are having no institutional structure. Then agricultural credit can be classified into based on purpose such as crop, investment, marketing, and consumption loans. Based on time, it can be classified into short term, medium term, and long term loans. Based on approach, we can classify it into individual area and DIR loans. Based on security, personal security loans are there, collateral security loans are there, chattel loans, mortgage loans, and hypothecation. Based on liquidity, there are self-liquidating loans. From the activity itself, we can pay the entire amount. Partially liquidating loan, it's a long-term loan where only a part of the loan can be paid by the business activity. Rest will be outsourced from some other activities. Based on the contact with the farmers, there will be direct loans, which is directly given to the farmers. Indirect loans, which will be provided through some institutions, like maybe through some schemes or through some self-help groups or something like that, or some farmer producer organizations or something like that. Then cooperatives is nothing but there is a voluntary association of members for the welfare of every members of the that group. So by Horace Plunkett, there are three maxims of cooperation: better farming, better business, and better living. Then in India, there are two types of credit systems, such as three-tier credit system and two-tier credit system. Short-term and medium-term loans. Short-term and medium-term loans. Short-term and medium-term loans will be given through the three credit systems. In the apex agency in the state, there is state cooperative bank. In the district level, there is district central cooperative bank, and in the village level, you can say there is a primary agricultural cooperative society. But when it comes to the long term, there will be only a two-tier structure. That is, at central level there is central land development banks, and in the um, uh, district level there is primary land development banks. This is actually often worked in taluk level also. Then there is single window system. These are some of the cooperative credit systems which actually helped to smoothen the process of agricultural finance in India. So single window system was actually conceptualized by Mohan Kanda in 1987 in Andhra Pradesh. So because of the two-tier and three-tier system, people had to go to different systems to get the short-term loan as well as the long-term loan. So in single window system, short-term, medium-term, and long-term loan will be given through a single window. That is nothing but the single window system is. Then the LAMS, Large Adivasi Multi-Purpose Cooperative Society, this actually was recommended based on Bawa Committee and established in 1971. And this was actually exclusively for the development of the tribal people. So that was another institution. Then Farmer Service Society, which was also developed, which was also consumed in 1971, which was recommended by the National Commission of Agriculture. So this integrated the credit service to the weaker section of the society, almost comprehensive coverage of the marginalized people, like small and marginal farmers, agricultural laborers, merchants, and masons and all. Okay. Then there were some social control and nationalization of the banks. So nationalization of the banks was like some of the banks were actually commercial banks which were actually having a accelerate rate of interest. So they tried to make it as a public sector bank so that they will be covering almost all sectors of the economy without actually having any bias to the rich or wealthy people. So that was the social control. So social control was established in 1978 and in 1968, and in 1969 the first spell of nationalization of banks was started. In 1969, 14 commercial banks were nationalized. 14 commercial banks were nationalized in the 1969. That was the first spell. And after that, there was a second spell in 1980. So additional 6 banks were also nationalized in 1980. So sum total from first phase 14 banks, from second phase 1980 6 banks. So total 20 commercial banks were commercialized in order to make sure that the credit is actually distributed to each and every part of the society. So this was actually the social control and nationalization of the banks. Then there is another important bank, which is the first commercial bank of India, that is nothing but the State Bank of India. So it was firstly it was Imperial Bank of India, and it was the first central bank of India before RBI was consumed. Then there are some specialized bank of SBI, which includes agricultural development. Sorry, it's not because of SBI. There are some specialized branches which was uh, developed by different banks in order to reach the remote areas of the villages to get catch hold of everyone who is actually requiring the credit. So SBI has developed the agricultural development branches and agricultural banking divisions. Bank of Baroda has developed the Gram Vikas Kendras. Dina Banks has developed the rural service centers. Syndicate Bank has developed the farm clinics. Indian Overseas Bank has developed the Rural Credit and Development Division, RCDD. So such kind of specialized branches were also consumed under different banks to get the marginalized people come to the credit system. Then there is lead bank scheme and RRBs. Lead bank scheme was actually consumed after the recommendation of FKF Nariman committee. At the same time, RRB was actually recommended by the Narasimham committee. This was happened in 1969, but RRB was consumed in 1975. Lead bank scheme is nothing but the largest commercial bank of a district will be taking the lead of the entire credit operation in the district. But at the same time, regional rural bank were actually a cooperative model banking, as the same way that we are seeing the Gramin banks or maybe cooperative banks in our villages. So this tried to operationalize the banking system in very remote places and include all the people. Okay. Then there is DICGC. Because of the non-repayment of the farmers or maybe the marginalized or poor, many of the banks were actually not meeting their targets, or they were not repaid with the loans that they have credited. So those banks should be having a kind of insurance policy. So therefore, there was another institution came in the central to give protection to the banks, such as Deposit Insurance and Credit Guarantee Corporation, which was actually formulated in 1978, merging the Credit Guarantee Organization, then Deposit Insurance Corporation and Credit Guarantee Corporation of India Limited. Then service area approach, which was proposed in 1988 by OJA committee, and the special feature was the branch manager was responsible for the branch credit plan. He had to know what actually has to be done in the particular area where the bank is working. Then there was farm graduate scheme, which was started by SBI. So this was actually a scheme which was ready to give some amount of agricultural graduates who are actually unemployed but are ready to start some agricultural operations. So that was farm graduate scheme. Then when it comes to the farm financial analysis, it is actually connected with the farmers level. Okay, when a farmer is planning his crop, how actually his area should be allocated with different enterprises, he will be using different kind of things such as balance sheet, income statement, cash flow statement, and break-even analysis. Balance sheet is actually this is actually an example of balance sheet. Balance sheet is actually, as the name suggests, it will be in balance. What the major components are nothing but first one is assets and the second one is liabilities. What is assets? The thing that he actually owns. Imagine that I am a farmer. I own some land. I own some machineries. I own some infrastructure. That are nothing but the assets. Upon their liquidity or solvency, or how I can sell it soon in the market, we can classify assets into current assets, which can sold easily. Intermediate assets, it will be taking a little time. Long time assets, you have to wait too much time to sell. Like you cannot sell land overnight, right? You have to go through many procedural formalities. Such kind of things that I own as assets, and liabilities that I have to pay to somebody else, or I can say the debts. The thing that I have to directly give now itself, that is current debts. for current liabilities. I have a little time to pay it, intermediate liabilities. I have too much time to pay that. That is nothing but the long time liabilities. So assets will be written in the left side of the balance sheet. Liabilities will be written in the right side of the balance sheet. So it will be almost balanced, and the difference between the total assets and total liabilities will be giving you the net worth. So if it is a positive number, asset minus liabilities is a positive number that you have and the additional things that you have already, right? So it is actually showing a better financial position of the firm. And there are many ratios that you can find out from the balance sheet, so that it will be assessing your profitability of the farm business. Then comes the income statement or profit or loss statement. Income statement is also known as profit and loss statement. So in income statement, we will be having two major commodities components. First one is receipts and second one is expenses. The cash inflow, the amount that is coming, is nothing but the income or receipts, right? And the amount which is actually goes to somebody else is nothing but the expenses. So the receipts as well as the expenses will be written, and we will be checking the difference, so that we will be understanding the financial position. So balance sheet and income statement. Then there is cash flow statement. If balance sheet and income statement was done for a particular point of time, it was done at a particular point of time considering the past data, or at that point of time. Okay, but cash flow statement, the third tool, is actually used to project what actually going to happen in the next year. Maybe for the first 3 months, then the next 3 months, then the next 3 months, and the final 3 months. So this is actually projected for the entire period in advance. But the balance sheet and cash flow statement, I am at this point of time, and whatever I am having, I am going to check it. Okay, so balance sheet and cash flow statement is done for a specific point of time. Balance sheet and income statement. Cash flow statement is actually done for a what we call for it an entire time period. So this is also known as cash flow summary statement, cash flow budget, or flow of fund statement. This actually helps to summarize all the cash flow inflows and outflows, so that if I am currently planning, okay, this much amount is going to come in June, but I have an expense at September, then accordingly I can plan where from I should get the credit, how I should harvest, where at what time I should sell, which is the period where I am not having much money, so that what I should do to manage the expenses in the farm, all the resource allocation things, everything can be planned in advance. That is actually the major the advantage of the cash flow statement. So this includes cash receipts and cash expenses like the income statement. So there are some farm credit appraisals or farm credit tests, which includes 3R, 5C, and 7P. So imagine that I am the banker. So you are coming to me to get some loan. So I just want to test whether if I am giving you this loan, if I will be getting it repaid back. So we will be checking the idea, like the capacity of the farmer to repay the loan, right? So we will be using 3Rs, that is returns, repayment capacity, and risk bearing ability. Then there are 5Cs, the character of the farmer, capacity, capital, condition, and common sense. And there are 7Ps, principle of productive purpose, for what it is actually used. Principle of personality, how the farmer is, whether he is actually a good person to repay the loan, he got some integrity or something like that. Principle of productivity, whether the loan is used for increasing the efficiency of the farm operations. Principle of phased disbursement, if it is a long term loan, the entire amount will not be given in a single spell, it will be given different spells in order to make it properly. Then principle of proper utilization, whether it is actually used for the purpose that he have taken, or he is actually diverting to something other purposes. Principle of payment, whether he is actually repaying it properly. Principle of protection, whether the farmer is actually getting protected from the use of credit from the unseen circumstances of risks and uncertainty. So 3Rs, 5Cs, and 7Ps helps the banker or the creditor to analyze whether the performance of the farmer is better, on par with the repayment. Okay, that's all about agricultural finance. Coming to agricultural marketing, just a moment. So coming to agricultural marketing, this is nothing but any activity which is performed to take the agricultural products from the farm gates to the consumer's plate. From gate to the plate, whatever things which is actually integrated in the process, that is called as agricultural marketing. So market is actually nothing but coming from a Latin word named marketus, which is nothing but to merchandise or to trade a particular product. So market is actually a place where demand for a product and supply of the product is actually converging. It can be a place, it can be an online platform, or even from entire different countries or from different points of the globe, there can be a market to be created, because there should be demand in one place and there should be supply in another place. So in order to define a market, there should be some conditions. There should be existence of a particular commodity, there should be a buyer and a seller, there should be a business relationship between the buyer as well as the seller, and there should be a demarcation of area, whether it is actually a village level market or a regional level or a country level or an international market. And finally, if these things are satisfied, then we can define that is a market. A product, buyer and seller, a business relationship, and the area of demarcation will be defining a market. Market can be classified based on the location as village market, which is located in the village; primary market, which is actually located in the towns or maybe district headquarters; secondary wholesale markets mostly in the district headquarters; terminal markets mostly you can see the markets near to the seaports or airports, like it has to be transported to some other countries or something like that, seaboard. Uh, so such kind of markets are classified based on the location. Then seaboard markets near to seashore, modern terminal markets, it's actually having some facilities of e-auctioning and all. Then based on the area of coverage, local market, which is actually just covering a little area; regional markets, maybe districts or states; national market, covering the entire states; and world or international markets between the countries. So area of coverage is increasing based on the time span. Short period markets, like maybe one day market, right, like Thursday market or Friday market, such kind of markets are known as periodic markets. Sorry, short period markets are like maybe the fish market that you are going into. It will be only for a little time period, like from morning, early morning to maybe like 11 o'clock or 12 o'clock, it will be closed. It will be opening next day, right? Such kind of things are known as, such kind of market is short period. Periodic markets, which is actually happening in once in a week or twice in a week. Long period markets, almost it will be a permanent market. And secular market, the market will be permanent in nature. Basis of the volume of the transaction, there are wholesale markets or retail markets. Wholesale market, the commodities are sold in bulk. Retail markets, commodities are sold in specific lots, right? If I'm taking maybe 10 quintals or 20 quintals, that is wholesale market. If I'm taking it for 1 kg or 2 kg, it is retail market. Then based on the nature of transaction, spot market and cash market, spot market or cash market, if you're buying a product, if you're selling, if you're paying it right away, then you can say it as spot market. Forward market is nothing but I am paying the money, but I am getting the product in some other point of time, maybe in the future. That is nothing but the forward market is. Then based on the number of commodities in which the transaction takes place, there are general markets, as if you are going to a margin-free supermarket. Every types of product will be there. But there will be specialized market. You cannot purchase rice from a fish market, right? It is exclusively for fish. That is specialized market. Based on the degree of competition, there can be perfect market and imperfect market. So imperfect market includes monopoly, duopoly, oligopoly, all those things I think you should always know. Then basis of nature of commodities, there are commodity market and capital market. Commodity market is exclusively for the transaction of goods and services. Capital market, in which we are sharing the capital or transacting the capital, like maybe the stock market or maybe share market, right? Such kind of things are coming under the capital market. Then based on the stage of marketing, there are producing market and consumer marketing. Producing markets are those things which are actually selling the producer goods, such as maybe fertilizers or machineries or something like that. Consumer markets, it is actually the marketing of the consumer goods, directly eatable, so directly consumable goods. Then there are regulated markets and unregulated markets. Regulated markets, government have strict rules and regulations, and when it comes to the unregulated markets, it is actually just open to everybody who can come trade and go. That is the unregulated market. Then type of population served, urban markets, which is serving urban population; rural market, which is serving rural population. And coming to another important thing, that is nothing but the producer surplus. Producer surplus is nothing but how much actually the farmer is produced. Let it be, if paddy farmer has produced maybe 10 quintals, okay, this is actually a part of this producer surplus, but this 10 quintals, maybe 2 quintals will be he have taken for the next cultivation, right, as a seed purpose. Then maybe 1 quintal he have taken for their family consumption for the future, and the rest 7 quintals is actually the only amount that he can supply in the market. That is nothing but the producer surplus. So after the requirements of the farmer, what he can supply in the market, that is nothing but the producer surplus. This can be classified into marketable surplus and marketed surplus. Marketable surplus is nothing but the same idea of producer surplus. What actually he have produced minus what actually he is consuming. That is actually the marketable surplus. So after consumption, what is left that he can sell in the market, that is the producer surplus. Sorry, the marketable surplus. But when it comes to the marketed surplus, even if he can sell the 7 quintals, if the price is very less, he will not be selling that much, right? He will be maybe selling only 3 quintals and he will be storing 4 quintals. So what actually he actually sells in the market, that is the marketed surplus. What he can sell in the market is marketable surplus. What he actually sells in the market, that is marketed surplus. If marketed surplus is greater than marketable surplus, this is almost in the case of small and marginal farmers. This is also known as distress sale. Okay, he is cutting down his expense and he is selling more. Yes. See, there is nothing too confused. Marketable surplus is nothing but after the consumption, what actually he have, that he can market, right? He can market at some point of time. We don't know whether he have marketed it or not, but after the expenses, he have something that he can market. That is the marketable surplus. What is marketed surplus? It is nothing but actually how much. See, the 7 quintals was ready to sell, but he is not actually selling it. He is actually selling only 2 quintals and he is storing 5 quintals. So what is the marketable surplus? 7 quintals. What is the marketed surplus? 2 quintals. That is the basic difference. I think it's clear right now. So in case of marketed surplus is greater than marketable surplus, you can say that the producer is actually cutting down his expenses and selling it more because he need higher cash requirements at that point of time. So it actually happens with the small and marginal farmers. Okay. Then when actually the marketable surplus is greater than marketed surplus, he have storage capacity. So it will be obviously attributed to the large farmers. In the case of perishable commodities, almost marketed surplus will be equal to the marketable surplus. So these are the relationship between the marketable and marketed surplus. So always remember that since he cannot store the commodity for too much time, the perishable commodity will be having marketed surplus equal to marketable surplus. Whatever left after consumption, he will be selling in the market. There is no point of storing it, right? And there are different factors which affects the marketable surplus, such as size of the holding, production, price of the commodity, size of the family, requirements of seed and feed, nature of the commodity, and consumption habits. Then there are marketing functions. Any activity which is performed to take the product from the gate to the plate can be considered as marketing function. Thomson classified marketing functions are primary, secondary, and tertiary functions. Coles and Earls classification classified marketing function as physical function, exchange function, and facilitative function. Then Huge and Mitchell's classification into physical movement function, ownership movement function, and market management function. And there are some different types of methods of buying and selling in the market. First one is sale under cover of a cloth. This is also known as Hatha method. Hatha, Hatha method. This is actually like people will be covering, like they will be closing their hand like this. They will be covering it with a cloth and they will be just pressing their fingers so that they will be having their own code language and they will be arriving at a price. Nobody else will be knowing it. That is the sale under cover of a cloth method. Sale through negotiations, like bargaining kind of thing. Sale based on samples. If a seller will be coming, he will be selling the samples to each and every every buyers who is actually offering good price. It will be sold entirely to that buyer. Then Morgan method. Morgan method is actually nothing but when the harvest price is actually the selling price, then it is called as Morgan method. Open auction sale method. It's like uh, a group of people will be there. The produce will be kept like this, and people will be loudly announcing how much money they are willing to pay. So the one who's actually having the highest bid will be getting the thing. And closed tender system, this is also another version of open auction sale. Instead of loudly saying the tender or instead of loudly saying the bid, they will be just enclosing it, writing in a paper, closing it in an envelope, giving it, and the one who is actually checking it, who actually have given the highest bid, he will be selling the getting the product. These are some of the methods of buying and selling. Then there are some intermediaries in the marketing channel. So from the producer to the consumer, there will be many middlemen, like wholesaler will be there, retailer will be there, processor will be there, broker will be there, or maybe such kind of middlemen will be there, right? So such kind of middlemen are classified into merchant middlemen, agent middlemen, speculative middlemen, and facilitative middlemen. Those middlemen who actually helps in the movement of the produce from one point to another point is nothing but the merchant middleman. Agent middlemen, they are actually becoming a middleman while they are trying to connect with the producer and the consumer. They are not taking the product, but they are just connecting the producer and the consumer. Speculative middlemen, those who are actually focused on the price movements. When the price of the commodity is less, he will be purchasing it and storing it. When the price goes up, he will be selling it. So at that point of time, he will be having more profit. Such kind of middlemen are speculative middlemen. And finally, the facilitative middlemen. These middlemen are actually helping in the smooth transaction through the agricultural marketing system. So if a producer is actually selling, thank you. Okay, so facilitative middleman is nothing but those middlemen who are actually working in the market, but they are doing some activities. That activities are actually helping in what we call for it, in making the marketing process more efficiently. When the producer is actually trying hard to unload, there will be some loading workers. They will be loading it easily so that some amount has to be given to them, right? There will be some graders, there will be some weighmen, there will be some people who are actually registering the producers as well as consumers there, right? So that will be automatically helping the marketing system to function smoothly. So such kind of middlemen are known as facilitative middlemen. And we are going to see some of the institutes such as NAFED. It is nothing but the apex cooperative agency in agricultural marketing in India, established in 1958. Some functions are there, like to promote cooperative marketing and undertake purchase and sale of supply of agricultural products, stabilizes the price of the essential commodities, such as some kind of functions are there. So always remember that when it comes to the institutions, mostly you will be getting a match the following question with the year of establishment. So always remember the establishment year. Then the APEDA, Agricultural and Processed Food Products Export Development Authority. It's not Agricultural Products Export Development Authority. Always remember it is Agricultural and Processed Food Products Export Development Authority, which was actually established in 1985. Then this is also actually an export-oriented cooperative, export-oriented institution, which helps in the trading of the agricultural products to other countries. Then there is CACP, that is nothing but a Commission of Agricultural Cost and Prices. Earlier it was APC, which was actually set up in 1965. Then it became CACP at 1985. Okay, this was came in under the recommendation of LK Jha committee. So CACP is actually an important institution which actually recommends the minimum support price in our country. Okay, so which is the institute which is actually recommending the minimum support price? It is Commission for Agricultural Cost and Prices. But who is actually announcing the minimum support price? It is the Government of India. So recommendation goes from CACP and the announcement goes from the Government of India. And right now I forgot who was the chairman of CACP. Just refer to who are all the current chairmans of these institutions, such as NAFED, APEDA, CACP, RBI, SBI, NABARD, all those things. Okay. Then, yeah, role of CACP we have already seen. Then there is Central Warehouse Corporation and State Warehousing Corporation. Warehouse is actually known as the protector of the national wealth. Warehouses are also known as protector of the national wealth because it is actually helping to store the commodities whenever the prices are less, and it is actually helping protection to the farmers also to get their fair prices, right? So Central Warehousing Corporation and State Warehousing Corporations are central and state bodies to promote the welfare activities among the farmers by giving them the storing facilities such as warehouses to the farmers. Then there is Food Corporation of India. Food Corporation of India has started in 1965. This is actually a major institute under buffer stock operation. So the public distribution system in India, which actually ensures healthy meal to each and every people in India, is actually procuring the food from the Food Corporation of India. So whenever the price is more or less, buffer stock operations is carried out by the FCI. So when the price is much higher, because demand is higher and supply is less, so at that point of time FCI will be giving the supply to the economy so that the price will be lesser. At the same point of time, when the price is much lesser, FCI will be buying from the farmers, so that the buffer stock operation is carried out by the Food Corporation of India. Then there is National Cooperative Development Corporation, established in 1963. Public distribution system, which was established in 1965, I guess. And there is again some advancements, such as revamped public distribution system and targeted public distribution system. So targeted public distribution system was in 1987, which was aimed to cover the population below poverty line. But at the same time, revamped public distribution system in 1992 to cover the tribal hilly areas and all. Then yes, that's all about the agricultural marketing. So yeah, we are almost approaching our time. So coming to the last topic, that is agricultural production economics. So what is an agricultural production economics deals about? So as we already know, agricultural production economics is actually a transformation process from some inputs to the outputs, right? From some inputs to the outputs, the activity is constituting the production process. So agricultural production economics deals with the functional relationship between the inputs as well as the outputs. The functional relationship between fertilizers, seeds, pesticides with respect to some of the final products, such as paddy, wheat, maize, corn, or whatever it is. So yes. So coming to some of the farm management decision making process. So farm management decision can be classified into organizational, administrative, and market management decision. Organizational management decision can be classified into operational and strategic management decision. Operational management decisions are the daily decisions: what to produce, where to produce, how to produce, such kind of things. Strategic management decisions are some long term decisions, like how actually the land should be allocated among different resources, what machinery should be purchased, because you cannot undone this decisions easily. But operational management decisions are like short term decisions. Even if it is goes wrong, you can correct it, but you cannot go for a strategic management decision very easily, and you cannot undo this one very easily. Okay. And there are administrative management decisions, such as the farm finance and all. Then there are marketing management decisions regarding buying as well as selling. So strategic management decision constitutes how best the farm size is, type of the farming, what type of farming, type of business, and how actually the land under irrigation, everything comes under strategic. Operation management, what to produce, how much to produce, and when to produce. Administrative decision constituting financing the farm business, how much investment should be done, supervision of the work, how it should be done, accounting and bookkeeping, or how it should be done. All those things are coming there. Then there are different principles which are applied to the farm management, such as law of diminishing returns, principle of factor substitution, principle of product substitution. So law of diminishing returns is actually concerned with how much to produce. How much to produce. Principle of factor substitution is actually concerned with the relationship between different inputs, like how better I could substitute between two inputs, or how better the combination of the inputs will be giving me maximum output. So it will be like how to produce. How to produce. How to produce. Then there is principle of product substitution. If almost in agriculture there will be a byproduct associated with a main product, so we should arrange how much product of main and byproduct should be produced. Or maybe we will be having, see, even if I have 5 acres of land, I will be allocating 5 acres, like I can go for monocropping, but I will be preferring multiple cropping, right? Why? Because I should get a continuous income, and even if one crop fails, I should get more profit from another. So how I should allocate between different products, that is nothing but the principle of product substitution. So this explain what to produce. What to produce. Okay, what to produce. Then there is principle of equimarginal returns, how actually the resources are allocated between different crops that I have selected under the 5 acres of land. Then there is opportunity cost principle. If I am giving 1 acre additional land for a particular crop, what actually I am sacrificing, whether that sacrifice is worth for that allocation of the resource to a particular crop. That is the opportunity cost principle. Minimum loss principle. Even if I am getting a loss, how to minimize that loss? at least covering the variable cost. That is the minimum loss principle. Principle of comparative advantage principle. When I am having two products that I am producing, which crop is actually fetching me more profit, I will be producing it more. Even if I am having a total loss, I will be giving more area to that crop which is actually giving me higher revenue, which is having relatively higher advantage. That is principle of comparative advantage. And finally, the time comparison principle. It is nothing but comparing see, agricultural operation are actually time consuming process. If you are starting a coconut orchard, you are not expected to get some profit after 1 year, right? You may have to wait for maybe 10 to 15 years, then only the operation will be full-fledged. At that point of time, we should be having how much revenue I will be fetching at that point of time, because time value of money is also should be considered. Such kind of ideas are coming under this time comparison principle. So yes, law of diminishing returns, how much to produce. Then the operation for LDR in agriculture is due to expensive dependence on the weather, division of labor having lesser scope, mechanization is having lesser scope because almost everyone is having small and marginal farmers, right? So such kind of things are coming. Then factor substitution, as we have already told, it is about how to produce. Principle of product substitution, what to produce. Type of products, there are two products, three products: complementary enterprise, supplementary enterprise, and competitive enterprise. What is complementary enterprise? Complementary enterprise is nothing but if I am adding something, it will be adding the revenue from the other enterprise. For example, why actually we are cultivating pulse in between rice cultivation? We have studied about nitrogen fixation, right? So 25% of nitrogen is already fixed in the soil, so that therefore the rice cultivation will be having lesser nitrogen intake. So that is actually complementary enterprise. What is supplementary enterprise? Without affecting one crop, you can add another crop, like intercropping. Supplementary enterprise. Competitive enterprise, if you are adding one, it will be detrimentally affecting another. Such kind of thing. They are competing for the resources, like in mixed cropping. That is nothing but competitive enterprise, right? Then equimarginal returns we have already discussed. Opportunity cost principle, comparative advantage, uh, time comparison principle. And coming to farm planning, what is actually farm planning is? Farm planning is actually defined as a total farm activity of a farmer drawn up in advance. So here actually what happens is like, if I am a farmer, I just want to know what are the things that I am planning in advance, so that how much cost is actually required and how much revenue it is actually fetching me back. That is nothing but the farm planning method. So farm planning can be classified in the simple farm plan and complete farm plan. Imagine that I am having 10 acres of land. 2 acres are for paddy, 3 acres are for some fisheries, 5 acres are for some plantation crops. So if I am just going to change the fisheries, if I'm just going to give some alterations on a particular enterprise without changing any other changes in the farm, that is nothing but the simple farm plan. But complete farm plan is nothing but I am fetching all the details of all the resources I am having, and I am going to change each and every activities here in order to fetch the particular activity. I am considering the entire farm as a whole. That is nothing but the complete or whole farm planning. Farm budgeting is nothing but when this farm plan is expressed in monetary terms. See, in farm plan, I am telling that, okay, crop, rice is cultivated here, wheat is cultivated there, or fisheries in this pond, or here this plantation crops. Here, in farm budgeting, I am trying to associate the cost and returns which is actually associated with each and every activity which is performed in the farm, so that I will be understanding whether that is profitable or not, or there are any better suggestions there. Such kind of thing is known as farm budgeting. So farm budgeting is three types: enterprise budgeting, partial budgeting, and complete budgeting. Enterprise budgeting, as I have already told, a particular enterprise is selected, the alternate modification, maybe I was using a traditional rice variety, right now I am including a high yielding variety. Obviously it will be having different fertilizer, pesticide, or irrigation requirement. So the returns and costs associated with that particular idea is changed. That is an enterprise budget. Partial budget, minor modifications in the farm, like I will be changing a little here, little there, and little there. I will be using the cost and benefit to understand it. Finally, the complete budget, like the whole farm plan or the complete farm plan is converted to the monetary budget, we will be getting the complete budget. Enterprise budget, partial budget, and complete budget. Then there are some kind of types of farming, such as specialized farming. You will be farming only a single kind of product. You will be going for a specialization of the product. Diversified farming, if you are having more crops in the same field, diversified farming. Mixed farming, crops plus livestock you will be cultivating. Dry farming, It's nothing but like regarding the upon the rainfall, the uh, dry farming is classified into dry land farming, dry farming, dry land farming, and rainfed farming upon the receipt of the rainfall, like less than 750 millimeters, 750 to 110 millimeters, and greater than 110 millimeters. Then ranching, it's nothing but the open pasture. Like if you are having some livestock, you will be going to some open fields and ranching them. So these are some types of farming. Then there are some systems of farming, which includes peasant farming, also known as subsistence farming. Then cooperative farming, which is also known as cooperative better farming, joint farming, tenant farming, and collective farming based on the ownership and operationship. Then there is capitalistic farming, as we have seen the capitalist system. Collective farming, where actually people pool their resources and cultivate a particular commodity or crop. And finally, state farming, which is farming under state control. State will be giving the plant, state will be giving the input. You have to just cultivate it. These are some of the systems of farming. Yes. So I think we almost stick to the time, and yeah, selection of the higher commercial crops for earning profit. Okay, complementary, symbiotic relationship between the crops. Okay. So somebody was asking regarding the demand pull inflation, right? So inflation is nothing but, see, easy idea to remember the inflation. It is nothing but too much money chasing too few goods. And I have 10,000 rupees. You may be having 1 lakh rupees. Each and everybody is actually having infinite number of amount with you, but there are only few commodities in the market. So I am ready to give any money to purchase that product because too much money is there chasing a very little goods there. Okay, so that demand is actually increasing the price of the commodity. One bottle of water was sold for 20 rupees. Right now water is scarce and everybody is having money, so I am ready to give 50 rupees. He was ready to give 100 rupees. So the demand actually increases the price. So water bottles price is increased to 200 or 300. That is the demand pull inflation. The demand is actually pulling the price of the commodity up. That is the demand pull inflation. I think it's clear. Very informative and concept oriented. Thank you. Thank you. I know it was a little faster, but we wanted to give a complete revision on each and everything. So I recommend you to go through the mock test, so that I think today's session also would be helping you to go through the questions and answer it very well. And if you have some suggestions and if it feels beneficial, recommend this platform to whomever you know, and feel free to give in the comment section also. And if any doubts, like, we'll wait for another 5 minutes to clear. And thanks a lot for the cooperation, and thanks for being with me for this entire 2 hours. Thank you. Okay, thank you. All the very best for your examination, and hopefully we'll be seeing in the future in the classes. Thanks.